compression. However, when we look at valuations, we think that the sovereigns really have played out their in terms of their spread compression. There has been a significant spread compression that we've seen, again, since the mid-90s to today, and a lot of that well-deserved. But going forward, I think that there's much more limited room for that to continue. The corporate sector, we think, however, has been an undiscovered sector, and I think that is a sector that is getting a lot more interest and a lot more looks, and we think that that's a sector that can potentially continue to benefit, again, not just from improvements in underlying credit fundamentals and potentially improvements in ratings, but also is attractively priced. The local currency sector at this point in time, it's a difficult one, again, because of interest rates. The expectation is that most of these countries are expected to increase their policy rates, and so interest rates are going to have a negative effect in terms of return, and also because of currencies. A lot of these countries are becoming very uncomfortable with the strength of their currencies, and as a result, we've had a significant number of policymakers implement changes to stop or arrest the strengthening of their currency. And so as a result, an investment in that sector, we feel may not have the potential payoff that one would expect. And so going forward, the sector that we've decided to focus on really has been the emerging market corporate sector. And with that, I think I'll turn it over to Maria.
Thank you.
Thank you.
Thank you.
Thank you, Luz. I think history has shown that companies sometimes have a better tendency of paying back than some governments do. So I think certainly, looking forward to upgrades and maybe some of those credits that have not been properly respected before in the market is something we're going to see going forward. So as our last panelist, we have Steve. Steve is with HSBC in London. He's the group chief economist and the bank's global head of economics and asset allocation research. He's directly responsible for their global economic coverage and coordinates the research of HSBC all over the world. And HSBC is truly a global bank, probably the only one that I know that is as global as it is. But anyway, Steve, since 2001, has been writing weekly for The Independent, the publication that I know well, one of the UK leading newspaper. He's regularly on both TV and radio, highly sought-out speaker in a global forum. He's written a book on Losing Control, which was published in 2010 by Yale Press, and we look forward to your comments, giving us a broader picture. Europe has been on the headlines with a couple of acronyms this year, so we look forward to hearing your thoughts on that. We're sitting around the table about the cloud over Europe, and we're talking about the headlines, how things sort of move forward and blow over. So that cloud moved over and another cloud came in, and hopefully there is nothing coming in the horizon. So share your thought with us. Thank you.
Well, thank you very much, and good evening, ladies and gentlemen. I should stress that I wrote the book last year because I was fed up with people saying to me, "Are you Stephen King, the author?" I can now say that, yes, I am. That was relatively straightforward. I wanted to talk about magic and about the acts of monetary magicians over the last 2 or 3 years. We've been engaged in a magic act that in one sense has gone not quite according to plan, like some of the worst of the magicians you might see. This magic act was associated with unconventional policies, quantitative easing, lots of printing money designed to kickstart the global economy. What has actually happened is that the parts of the world economy being kick-started are the wrong parts. We've seen a kind of giant carry trade story coming through. People have borrowed very cheaply in dollars, euros, sterling, and yen. They invested very, very heavily in the emerging world as opposed to in the developed world. And the consequence of that is that you've seen what's been an extraordinary period of decoupling. 2 or 3 years ago, people said decoupling couldn't happen. It clearly has happened, because if you look at the performance of the States, Europe, very disappointing by past standards. If you look at the performance of China, India, Brazil, been absolutely extraordinary by past standards. The big difference between these two groups of countries is that the emerging nations, as you just heard, have relatively low levels of debt, whereas the developed nations have incredibly high levels of debt. And those levels of debt really haven't gone away. They're an extraordinary headwind that's prevented the developed nations from recovering in the usual way. Now, as far as the stimulus is concerned, it's worked particularly well in the emerging world because of this lack of debt. But it also means that the emerging world is now in danger of overheating. So what do these countries do about it? Well, the conventional sense would be that they're going to go for currency appreciation and they'll go for higher interest rates. That, though, is not necessarily the most likely scenario. These countries are terrified of major currency appreciations for one reason or another. As what we see in the West as quantitative easing will be replaced in the emerging nations by what I would call quantitative tightening. It means changing collateral requirements for loans. It means raising reserve requirements. But it also means the spread of capital controls around the emerging world. This is a new theme. We've been used to, over the last 20 or 30 years, the diminution of capital controls, the increasingly free movement of capital across borders. This is in danger of going into reverse, an unintended consequence, if you like, of the process of printing money in the Western world. As far as the West itself is concerned, well, we've got a decent recovery hopefully coming through in the US at the moment. We're looking for growth this coming year of 3.5%. Doesn't sound too bad. It's worth stressing that 3.5% by US past standards actually is not very impressive. If you look at the first year of recovery from very deep recessions, the standard pattern is that growth here comes in at 5 to 7%. 3.5% I would say is subpar. It leaves you with still very low levels of economic activity and of course a relatively high level of unemployment. If the Western world is going to recover, it has to confront head-on the debt issue. What we've seen so far in the Western world is debt being redistributed away from the corporate sector towards the household sector or to the government sector, but debt levels as a whole are still incredibly high. Now, how is this playing out? Well, we've heard before this issue about the Eurozone. Well, the Eurozone really has a choice to be made over the months ahead. It's a choice involving both creditors and debtors. The assumption last year was the debtors would deal with their debts by delivering continuous austerity. The Irish in particular were seen to be in the forefront of this process, stoically accepting the austerity that was required. But in the process of delivering austerity, they ended up with a banking crisis. Although the budget deficit came down, government debt as a share of GDP went absolutely through the roof. The danger now is that if other countries follow this path, they too will find themselves with very high levels and possibly increasing levels of government debt. So I think that the solution to the Eurozone is twofold. Probably some kind of what I'd argue is an organised process of restructuring. Not a sudden default from Greece or Ireland or Spain, but an acceptance that both the debtors and the creditors have a responsibility in this crisis. And the creditors here include the Germans, who lent far too freely and far too cheaply to the peripheral nations within the Eurozone over the course of the last few years. I think we also see in the Eurozone a further political change in the months and quarters ahead. When you had the ERM crisis back in '92, what happened? Well, the UK exited from the ERM, went its own separate way. But the majority of countries in Europe said, we don't want to have our own separate currencies, we'll form a common currency, a single currency called the euro. What we're now moving towards, not just a single currency, but also a single bond market, a single fiscal arrangement in the years ahead, a pooling of fiscal activity in a way that we haven't seen in the past. It's a kind of active union, if you like, for the Eurozone. But the Eurozone is not the only part of the world with high levels of debt. The peripheral nations in the Eurozone are debtors, Germany is the creditor. At the global level, the equivalent of Germany are countries like China, Russia, Saudi Arabia. I'm afraid to say that at the global level, the equivalent of the peripheral nations in the Eurozone is right here in the US with incredibly high levels of debt. The big question is, what does the US as a debtor do about its debts? Well, it's not going to default, it's not going to restructure in the way we're going to see in the Eurozone, but more likely is that you will see a major crisis in currencies over the course of the next year or so. And this crisis can be described in one of two ways. Either you can think of this as an emerging market revaluation, or specifically a renminbi revaluation, or instead you could describe it as a dollar devaluation. The advantages for the US of going for a much weaker currency are that the US has borrowed from the rest of the world in dollars. So if the dollar goes down, it will feel like a default to the foreign creditors, including the Chinese, the Russians, and the Saudi Arabians. Now that may sound fine for the US in the short term, but what it also means is that the US will suddenly find that its reserve currency status is up for grabs. This would be a major vulnerability for the US over the course of the next couple of years. And as the world economy develops, being led by the emerging world in the years ahead, we'll find over the next 10, 20 years that the dollar will lose its reserve currency status altogether, and it'll be the renminbi that becomes the world's reserve currency. Thank you very much.
Okay, on that positive note, we move forward. Okay, we got some good questions to start out with. And the first one, like I said, we'll go with Jordan. There's a question for Jordan. I think Paul qualified to answer. Do you think the stock market's action over the last 6 months have finally discredited Robert Prechter and Elliott wave theory? And a follow-up to that is, can you summarize what you said before?
I'll say it again just a little faster to save time. No, honestly, I'm not jacked up on Red Bull and I'm not nervous. I've just spent my career on a trading floor, so talking fast is just... I really tried to slow it down. I promise I'll slow it down even more. Let me summarize just a couple of things. We like commodities higher, base metals, softs, ags to the top side, feeding the fears of inflation. You look at the break-even market for that. Interest rates will be key. We think interest rates will be the key trade for the next 10 years. We like stocks, but we just don't think we're going in a major bull market. We're just going to the top of the range. And in foreign exchange, the dollar is just a massive range trade, so the money is to be made on the cross rates, of which we like Canada in particular on the cross rates. So that would be a bit of a summary. I didn't mention the gold market. We really like gold. Okay, Robert Prechter, Elliott Waves. I should tell you, Bob Prechter, for those of you who don't know him, runs Elliott Wave International, biggest forecasting house in the world. Bob Prechter